In this video, we update our mortgage stress results to the end of March 2018. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. We've released the March 2018 Mortgage Stress and Default Analysis Update. Across Australia, more than 956,000 households are estimated now to be in mortgage stress, compared with 924,500 last month. This equates to 30% of all owner-occupied households. This chart shows the trend from our modelling. In addition, more than 21,000 of these are in severe stress, so not much change from last month. We estimate that more than 55,000 households risk 30-day default in the next 12 months. And we expect bank portfolio losses to be around 2.8 basis points, although losses in Western Australia are likely to be higher at 4.9 basis points. Flat wages growth, rising living costs, and higher real mortgage rates are all adding to the burden. Our analysis uses the DFA core market model, which combines information from our 52,000 household surveys, public data from the RBA, ABS and APRA, and private data from lenders and aggregators. And the data is current to the end of March. We analyse household cash flow based on real incomes, outgoings and mortgage repayments, rather than using an arbitrary 30% of income. Households are defined as stressed when their net income or cash flow does not cover ongoing costs. They may or may not have access to other available assets, and some have paid ahead. But households in mild stress have little leeway in their cash flows, whereas those in severe stress are unable to meet repayments from current income. In both cases, households manage this deficit by cutting back on spending, putting more on credit cards, and seeking to refinance, restructure, or sell their home. And those in severe stress are more likely to be seeking hardship assistance and are often forced to sell. We continue to see the number of households in difficulty rising, and the quantum is now economically significant. And things will get more severe, especially as household debt continues to climb to new record levels. Mortgage lending is still growing at 2 to 3 times income, and this is not sustainable, and we are expecting lending growth in any case to continue to moderate in the months ahead. The latest household debt to income ratio is now at a record 188.6, as we discussed in yesterday's post. Overall risks in the system continue to rise, and while recent strengthening of lending standards will help protect new borrowers, there are many households currently holding loans which would now not be approved, and the recent Royal Commission laid bare some of the industry practices which help to explain why stress is so high. This is a significant sleeping problem, and the risks in the system remain higher than many recognise. The forces which are lifting mortgage stress levels remain largely the same. In cash flow terms, we see households having to cope with rising living costs, noticeably childcare, school fees and fuel, whilst real incomes continue to fall and underemployment remains high. Households have larger mortgages thanks to the strong rise in home prices, especially in the main eastern state centres, and now prices are slipping. While mortgage interest rates remain quite low for owner-occupied borrowers, those with interest-only loans or investment loans have seen significant rises. And we expect some upward pressure on real mortgage rates in coming months as international funding pressures mount, a potential for local rate rises and margin pressure on the banks thanks to the higher bank bill swap rate. The probability of default extends our mortgage stress analysis by overlaying economic indicators such as employment, future wage growth, and CPI changes. And our core market model also examines the potential of portfolio risk of loss in basis point and value terms. Losses are likely to be higher among more affluent households, contrary to the popular belief that affluent households are well protected. And regional analysis shows that New South Wales had 261,000 households in stress, up from 260,000 last month. Victoria, 258,000 compared with 249,000 last month. Queensland, 176,000 compared with 165,000 last month. And Western Australia, 126,000 compared with 130,000 last month. The probability of default over the next 12 months rose, with around 10,500 in Western Australia, around 10,300 in Queensland, 13,800 in Victoria, and 14,800 in New South Wales. The largest financial losses relating to bank write-offs reside in New South Wales at 1.3 billion from owner-occupied borrowers and 960 million from Victorian owner-occupied borrowers. And that equates to 2.09 and 2.76 basis points respectively. Losses are likely to be higher in WA at 4.9 basis points, which equates to 726 million from owner-occupied borrowers. Finally, here are the top 10 stressed postcodes across the country, sorted from the highest number of households. Watch this at your leisure. We continue to see mortgage stress still strongly associated with fast-growing suburbs where households have bought property relatively recently, often on the urban fringe. The ranges of income and property prices vary, but note that it is not necessarily those on the lowest incomes who are most stretched. Banks have been more willing to lend to these perceived lower-risk households, but the leverage effect of larger mortgages has a significant impact and the risks are underestimated. We will continue to monitor mortgage stress and will update our core market model next month once again. Finally, I think it's worth repeating that many households in stress do not have a robust household budget, and creating one is an important first step to getting to grips with stress. Whilst putting more on credit cards and refinancing may seem superficially attractive mitigation steps, our analysis shows that these are often only temporary fixes. Getting to grips with where the money is going is an important first step to tackling the problem. Remember too that banks have an obligation to assist in cases of hardship. So if you are a household in difficulty, talk to your lender rather than just hoping things will work out. Given flat incomes and rising prices, this is unlikely. You may want to watch our recent video blog on Should I Buy Now, where we discuss this in more detail. If you found this useful, please do like the post and add a comment or a question. I read them all. And if you've already subscribed, thank you. I'm really grateful for your support. And if you are yet to subscribe, please do so to receive future alerts. I'm Martin North, the Principal of Digital Finance Analytics. Many thanks for taking the time to watch.